The next section I want to take a look at is the policy impact. And that's the government policy, and we can break them into two categories. Monetary, which is the Federal Reserve, interest rates, money supply. Then we can break it into fiscal, tax, and spend. So these are the policies that impact on employment numbers, GDP, how companies do business, etc. So let's take a look at the key ones. What you have is you have policy output. These are things actually done by agencies. And then there's policy outcome results. And these are the consequences, intended and unintended, that stem from deliberate government action or inaction. The impact is a combination of multiple things. Global countries, global cultures, not just financial issues, but social actions. And they're different around the world, but how policy is implemented, defined and implemented, impacts the future of business. Let's take a look at inflation and interest rates. We'll take a look at government spending and taxes, all within the context of inflation, which has become a bigger issue. And then healthcare. Let's take a look at what inflation is. It's been a big number now. It's becoming more important. It was transitory. Now I guess it's going to be with us for a while. Well, let's say inflation is measured by the CPI, Consumer Price Index. So what is happening is over time, prices are rising. Well, why are they rising? Well, strong economy, energy prices, government policy, and we're seeing other causes, COVID now, but it's the supply change. But this comes around to the economy and that. So we're looking at prices rising over time. Now that can be good or bad. The positive results in higher paychecks for us. It can help the economy grow, and it helps borrowers. The negatives is expenses go up, and too much is bad for growth. It'll just slow growth. Is bad for lenders because they get squeezed. So we're looking at this is you need a level of inflation that's good, but you don't want it to run too hot. Now, what came out in November is the inflation rate, the consumer price index, was 6.9%. That means prices annualized were up 6.9%. We haven't seen that since the 1980s. And you can see that inflation had been running actually pretty low for the past 40 years. Now, this we talked about earlier, labor force participation rate. So what you should see with inflation conceptually is these people coming back into the workforce, which would slow that down. But as we saw other factors, that may not happen. Generally, when you have inflation, interest rates tend to go up. And we've seen that here. If we're looking at 2-year yields have risen quite a bit, as we can see here, the 30-year or 10-year hasn't. But we still really don't have high interest rates relative to the rate of inflation. That's an interesting phenomenon. If we look at where inflation is, we can see that energy, 33.3%, that goes up. This is what's happened with the price of oil. We're now seeing oil come down, so that is relieving pressure. Transportation is up. Total CPI at 6.8. Food is 6.1. Remember what we said about the low-wage worker? They spend more on food, so they're going to be more negatively impacted than the high income. Apparel is up. Housing is up. Some of these other things are actually not too much. So we really say these are the volatile categories, so we're up 6.8 in total, and the less volatile ones are 4.9. We're still experiencing inflation, and it hit a 39-year high, and the long-term goal, the average is 3.3, and that has been what we've been at, if you're looking, and then all of a sudden it's starting to take off. So we're really at the highest level in an awful long time. And that presents a challenge for both policymakers at the monetary side of the Federal Reserve and at the fiscal spending side. If we look, the other thing that came out just the other day was not just the consumer price income index, but the producer pricing index. This is the one that is the manufacturing side, those that produce goods. Now, if their costs are going up, those costs are generally passed through to the consumer. So we've seen a actual of really quite high, almost 10%, which is going to work its way into the economy, if you will. So we should expect higher inflation as we move forward, for at least for the next year or so. Now, I threw this chart in because I think it's meaningful. What we have here is the crude stock of oil. This is how much oil is available. And as you can see, in 1921, we're at the lowest level of actual oil in the system. So what we're seeing is a little bit of supply pressures because oil wells you can turn on and off. They're costly, but you can control production a little bit. So we have that going on. If we look at what the FOMC, which is the Open Markets Committee, we're looking at, they made an estimate for 22 and 23 and 24, and as you can see, 21 continues to be high, and their forecast has increased. So we're going to see this. It's not as transitory as we thought. And if we look at how this has worked, and this goes back to 2000, so that's 20 years, you can see some of the things that drive inflation. Oil being a big thing, we wanted to target about 2%. And right now, as you know, we're not. One of the other things, and I probably should have put this in a little different order, but oil has two costs. The cost of drilling a well and the cost of producing and transporting the oil that comes from the well. So at, say, $70 a barrel, some wells are not profitable. So what we're seeing is that when we look in the future, that OPEC has capacity, but they're not producing it right now. This is the demand, the red line. JP Morgan is saying this is your demand. So what we're seeing is we'll see more oil coming on at $70 a barrel in 80. But it looks like we're going to keep relatively flat over the next number of years, which should help keep the price of energy within a narrow. So as we start, so that's the backdrop of inflation. Now let's look at monetary policy. Every country has a central bank. Some are independent, some are part of the government. In the U.S., Congress oversees the Federal Reserve System, and that consists of a board of governors who govern it, the Federal Open Market Committee, which is members of the board of governors who are board of governors and Reserve Bank presidents, the chair, and they're making policy decisions. Then there's individual Federal Reserve banks spread around the country, and that's the operating arm. When we look at the Federal Reserve, they have two mandates. And one is price stability, making sure inflation doesn't run too hot or too cold, and then maximum employment. So it's following this balance, what they're trying to do. And today, we're finding this has all changed. So where this had been very easy in the past, we're finding that we don't have a really big price stability, but we're not sure if this is just a transitory thing or whether this is long-term. The Federal Reserve has actually stopped using the word transitory. I think inflation is going to be with us for the next couple of years. But maximum employment, when you have the low unemployment rate, but it's driven by the lack of people in the workforce, that's not something that in the past has occurred, and traditional monetary policy hasn't been able to address that. What can the Federal Reserve do? Open market. They can buy or sell bonds. And what that does is it creates liquidity. Next thing is they can lend to member banks. And the rate that in the Fed funds rate, and that's what banks charge one another for overnight money or short-term loans. They can require more reserves, which sucks liquidity out. Now, the Treasury does not set rates, okay? they have long-term market sets long-term rates. But by some of the actions they can do, they can establish target rates for what's called Fed funds, the overnight money, which drives the interest rates. And as you can see, they're looking at it going up. We're almost at nil right now. And as we move into 22 and 23 and 24, we're going to see it moving back up, which would have the impact of slowing inflation. But you don't want to slow it too much because that could put you in a recession, which would work on the opposite side with employment. So it's this balance. In reality, what drives interest rates? Supply and demand for money? Absolutely. The more demand there is for money, the higher the rate. The lower the demand, the lower the price. Well, where are we today? There's so much money in the system, and people don't need to borrow as much. So that's keeping rates down. So yes, inflation can impact it, but if there's no demand, and that's what we're seeing, is there's so much cash. So some of the actions the Federal Reserve will take will impact the supply and demand. What also drives interest rates? The risk and return profile. The longer the term, the higher the rate. The shorter the term, the lower the rate. The greater the credit risk, the higher the rate. And the better the credit, the lower the rate. Important to see these, especially when we get into financial statement analysis, looking at what interest rates, what's the impact of interest on companies today and our modeling of them. Now, we're going to start that U.S. government securities have no principal risk. They do have inflation. Right now, I took this, I'm doing this at 12/20, 10/52. What we see here is these are the current yields for the maturity. So even though we got 6.8% inflation, we're seeing a 10-year note at 1.382. So if you bought that 10-year note, you're actually going to be losing money. Why is that? One, that the market does not think this 6.8%, 6.9% is sustainable. Okay, so we're seeing very low interest rates. Now, if we look at this, what's happened over the past year, we saw in January it went up, actually hit 175, and then it's declining, and it declined again today. So you can see interest rates are really low. This has implications for how companies borrow, how we invest as individuals. Important thing. Now, some forecasts that I'm seeing that will be 160 at the end of the year. I think we'll be there. 22, 180, 230, 250. The futures market isn't expecting that, but Goldman Sachs' forecast is for it to be higher. And that affects the cost of borrowing, and both from an individual perspective and a corporate perspective. Now that we've talked about monetary policy, and that's what we've been talking about, let's move to fiscal policy. And that's how the government spends money and raises money. The terms expansionary and contractionary are used the same way in relation to fiscal policy as monetary. If it's expansionary fiscal policy, it helps speed up the economy or increase economic growth. Contractionary fiscal policy slows things down and slow economic growth. Now, if you're trying to manage inflation, you want to do that. But if you want to create jobs and low unemployment, you need to have little expansion. So the Fed is trying to do what they can within their power. Okay? They can't control the supply chain. They can't control demand. They can control liquidity in the marketplace and a major influence on interest rates. So when we look at what fiscal policy is, in expansionary, you got more government spending and less taxes. Conversely, on the other side, taxes are greater than spending. So when we're expanding, government spending is greater than what's coming in, borrowing. And if it's contractionary, we're taking in more than we're spending. We haven't seen this in a long, long time. When we're looking at what's going on today, how the U.S. fiscal policy is actually dragging down growth because they've borrowed so much and we're spending so much, deficit spending, that's going to reduce growth. Let's just take a look at some of the things that have happened. We have the Tax Cuts and Jobs Act, goes back a couple of years. And what it did is, honestly, it just reduced taxes across the board for individuals and for corporations. This chart can see who benefits the most from it. as to what they got as a tax benefit. Now, there's pros and cons, as we said. It reduces unemployment, reduces inflation, or the expansionary fiscal policy can reduce unemployment, lead to inflation. On the other side, reduces inflation, could increase unemployment. So they're trying to balance that. Now, tax policy really has two aspects. It can generate revenue for government to pay for expenses and projects, but also to encourage certain behaviors. The behaviors can be to incent spending by you and I, or companies, and the intent is to use taxes as cause and action. That's me to buy an electric vehicle, maybe, put solar panels on my roof, for a company to invest in new equipment and new buildings. So they're trying to stimulate growth by causing certain behaviors. Okay? The biggest thing we had was in 2018, where the went from a variable tax rate to a fixed rate of 21% for corporations. Now, so companies save money. Now, the goal was, behaviorally, what we wanted to do was these companies to make investment in the future. More people, equipment. No. What happened is it all went to dividends and stock buybacks, reduced debt. Okay? So very little investment. So it didn't behave the way it was intended to. Then we had COVID. Okay? And the U.S. government, state governments have been spending a bundle. The first one was March 6. We spent 8.3. Then the Families First came, 3.5. Then March 27. This is all of 20. The CARES Act, which was $2 trillion. Now, the government didn't have this money. They had to go out and borrow it. But they're having to pay it back. April 24th, we had the Paycheck Protection Program, healthcare, another $310 billion. And then in January 21, we had the American Rescue Plan. So a lot of government actions have been taken to stimulate the economy, but also to reduce the negative impact of COVID-19 by the government spending. For the president's discretionary budget, it breaks down. This is not including the other two plans that he has for infrastructure and rebuilding America. So you can see we spend half of the money of the government goes into the military. You'll find that's a huge number. And then you can see it's spent around where it is. We can see that, labor, Department of Labor is a big piece, veterans benefit, housing and community. So this is how the budget for the year shapes up. Now, that's great, but the government doesn't have the revenue to pay for it. So they're going to be borrowing more money. So the government will be borrowing, it looks like $3.8 trillion here, continue to borrow well above the average, the projection. So it's clearly going to continue to spend. When we look at the CARES Act, and I want to go through this just so you get a sense, which is the $2 trillion one that was March of last year, gave $560 billion to individuals. That's the stimulus payment. We got big corporations got $500 billion, small businesses $377, state and local governments $340. They put $153 into public health and then a little in education. But this all comes up to $2 trillion is what has been spent or trying to spend. The infrastructure bill, which was passed, is $1.2 trillion, and you can see that it is a lot of really infrastructure. The biggest piece being roads and bridges, the power grid, freight rail, broadband, water, resilience, and airports. Really go into infrastructure. So it's a more dedicated spending to create jobs and to rebuild our infrastructure. I think you've driven on enough roads to know that we need a lot of work on them. Power grid, we need these things to be done. Then there's Buildback America, and that's another $1 trillion, $2 trillion. Again, as we look at it, family and benefits get a piece of it, climate and infrastructure, tax credits, healthcare. So that's the spending on